In this video, I want to go through a CFA Level 1 exam style question on the intuition behind goodwill. Goodwill is a very specific and important non-current asset, more specifically an intangible asset. It's discussed in your curriculum readings. You're supposed to understand how to deal with goodwill as an analyst, although at level 1, you're not going to be asked to compute it. That comes at level 2 and forms a large part of the financial reporting and analysis curriculum. I think that understanding goodwill is going to be much easier if we do a bit of computation. If you at least once compute goodwill, you'll understand where it comes from and how to deal with it as an analyst. So in this question, we'll do some computation. However, in the exam, you won't really be asked to perform similar steps. In any case, if you want to understand the intuition behind goodwill, if you want to get goodwill questions right in the exam, please keep watching and let's get solving. So, this is the question which I want us to have a go at. Excelsior Hospitality plc, a hotel holding company and owner of the Excelsior Hospitality Group, acquired a stake in the share capital of Manor House Resort and Spa. At the date of acquisition, Manor House's summarized balance sheet showed, and this is in millions of euro, as you can see, some very simple items of assets, property, plant, equipment, trade receivables and cash. And on the other side of the balance sheet, we've got equity and two types of liabilities. Manor House's property, plant and equipment, so the PPE, includes land and buildings whose fair value exceeds the reported book value by €2 million. In addition to this, the Manor House brand and logo have been valued at €2.5 million. The fair values of the company's remaining assets and liabilities are equal to the book values presented in the balance sheet above. Let me stop there for a moment. The reason why we've got this information on the logo and brand being valued at €2.5 million, however, that information being missing from the assets of the company is, as you may know from your previous studies, that internally generated brands and logos cannot be shown in the company's own balance sheet. There is a prohibition both under IFRS and US GAAP that stops companies from showing the value of their own internally generated items such as brands and logos, and this pertains to many intangible assets which have been internally generated. However, when somebody buys a company together with its brand and logo, they will absolutely be forced, even, it's not even an option, you'll be forced to put a fair value on the acquired brand and logo, and that's the information we've got over here, €2.5 million. Assuming Excelsior pays €18.5 million to acquire 100% of the share capital of Manor House Resort and Spa, what is the goodwill reported on the consolidated balance sheet of the Excelsior Hospitality Group as a result of the acquisition? So a rather long scenario, but we'll be using this scenario later on as well in subsequent questions where I'll be showing you more of the intuition behind goodwill, as well as trying to explain how to deal with minority interest or non-controlling interest. We'll be using the same scenario in follow-on questions. Okay, your book, your curriculum, which is kind of in line with what IFRS and US GAAP says, defines goodwill in a very mathematical way. It's the excess of the purchase price in an acquisition. And in this case, the purchase price is stated in that last paragraph over here, €18.5 million over. So in a way, that's the same as saying purchase price minus and let me get this right, the acquirers, so the purchasers, interest in the fair value of the net assets acquired. Now, I'll explain this in a moment. So, what we need to focus on now is what's the fair value? Not the balance sheet value, but the real fair value. For now, we can treat this as a synonym of market value of the assets minus liabilities that we are acquiring into our group when we're purchasing another business. Now, this bit, acquirer's interest, pertains to how much, what's the portion of share capital that you're acquiring. In this case, it's nice and easy because we're acquiring 100% of the share capital. So right at the start, I'm going to say 100%, and that's kind of dealing with the acquirer's interest. In follow-on questions, we'll be changing this assumption to something other than 100%. And now let's open up a big square bracket to get those net assets and their fair values. Well, the assets are listed in the balance sheet. We've got property, plant, equipment, trade receivables, and cash. From those, we're going to deduct the liabilities. But below the balance sheet is this information about the fact that the PPE, the property, plant, and equipment, includes some land and buildings whose true fair value, the market value, exceeds what's reported in the balance sheet. So over here, there's 12 million. This shouldn't be any surprise. Typically, when we report something in the balance sheet, we report it at cost minus subsequent depreciation. The true market or fair value of that asset may be completely different. And in the case of buildings, property, that will often be higher than what we've got in the balance sheet. So I'm interested in fair values over here. So instead of writing 12, I'm going to have, let's open a bracket, 12 plus 2. So this adjustment up to the fair value of the property, plant, and equipment. To this, I'm going to add also the value of the brand and logo, 2.5 million. That's obviously coming from the scenario over here. It doesn't appear in the balance sheet of the target company because it can't. It was internally generated. Nevertheless, I need to include it in my computation of the overall fair value of net assets acquired. And then I'm going to simply add the value of the trade receivables, 4, and cash, 3. And I'm taking these numbers directly from the target company's balance sheet because in the text it says the fair value of the company's remaining assets and liabilities are equal to the book values presented in the balance sheet above. So it's okay to take the 4 and 3 directly from the balance sheet. Because we're looking at net assets, I need to make a deduction for the liabilities. So the bank loans, 6, and trade liabilities, 1.5. Okay, and I think this completes our overview of the net assets acquired, at least when they are stated at fair value. 100%, treat that as synonymous with 1. And then in the bracket, 12 plus 2, that's 14. Then we've got 4 and 3, that makes 7. So 14 plus 7, 21. And then add the 2.5, that's going to be 23.5, and deduct what in total is going to be a negative 7.5. 23.5 minus 7.5, I guess, gives a nice 16 million euro of fair value of net assets. However, to compute goodwill, we need to deduct this number, the 16 million, from this number, the purchase price. So goodwill over here is going to come in at the difference, 18.5 million minus the 16 million, which obviously generates 2.5 million. Let's see if we've got an answer which corresponds to this result. Yes, we do. It is on the left-hand side over here, answer A. Let me write this down. So question solved. However, I don't just want you to be able to mechanically compute this. I want you to understand what the impact of goodwill is on the consolidated balance sheet and what role it plays. So having solved the question, I'm still going to take you to a balance sheet template. So here is the balance sheet template, and I'm going to try and show you using this template what happens in the consolidated balance sheet following the acquisition of a new group member. Now, what we'll be doing is trying to incorporate all of the assets and liabilities of the new subsidiary into our group financial statements, including the balance sheet. So line by line, we'll be trying to put those in, starting with property, plant, and equipment. So let me write over here PPE, which on a group level grows by what the newly acquired target company brings into the group. Now, what we'll be registering over here is an increase of 14. So the value 12 adjusted up to fair value. When we bring a new company into the group, we initially recognize and record everything that's brought in, so all the assets and liabilities at fair values. Subsequently, this will form the base for the further recognition and measurement of this asset, and it will be subject to depreciation, etc., etc. So all the follow-on consequences of having assets in the balance sheet. But when we initially record these assets, it will be done at fair value. We also had the brand and logo, so some form of intangible, brand and logo. And this, as far as I remember, was valued at 2.5. So same story, I'm bringing it in at 2.5. Its estimated fair value. We also had some trade receivables, and these were valued at 4. And there was also cash, which, as I remember, was valued at 3. So these are all of the assets which are brought into the group together with the newly acquired company. We also have some liabilities, which I'm obviously going to record over here at the group level. And I know those were comprised of a bank loan and some trade receivables, one with a value of 6 and the other 1.5. I'm just going to, treat them as one thing, just the liabilities. I'm just going to say group liabilities grow by whatever the sum of those two items was. So 6 and 1.5 was in fact 7.5. Okay. Now, in order to purchase this new group member, the parent company had to spend some money, which obviously went out of group cash. How much money was spent? What was the purchase price? Let me check back in my notes. It was supposed to be 18.5 million. So out of group cash, there must have been a cash outflow of 18.5, and this is a flow which is suffered from the parent company's cash position. The items on the left-hand side, the ones in green, are supposed to represent what the new group member brings into the family, the group. Okay, if we just leave it like this, introduce the newly acquired assets on the left-hand side of the balance sheet, the liabilities that come with the new group member on the right-hand side, and obviously record the outflow of cash, this balance sheet will not necessarily balance. So let's see what these numbers give us so far. On the assets side, I've got 14 plus 2.5 plus 4 plus 3. Well, this is 7. 7 plus 14 is 21. 21 plus 2.5 is 23.5. And if we deduct 18.5, the cash outflow, we get 23.5 minus 18.5. That's on a net basis, growth equal to 5 so far. On the other hand, our equity and liabilities, primarily liabilities over here, have only grown by 7.5. So far there is no balancing in the balance sheet, and that's a problem to be solved. And the way you solve it is by increasing the value of assets by the item that we already calculated, known as goodwill. If you've spent 18.5 to purchase a company, but in return, for this money. You've stuffed your assets and liabilities with entries that have a net value lower than 18.5, and we calculated, the fair value of net assets acquired. I'm sorry to be doing this over our income statement, but it's not going to be needed, at least in this example. We said it was 16 million. You can go back a few minutes in this video and check that this was the answer. Well, we've spent 18.5 million to acquire what on a net basis is a company with these assets minus these liabilities, so 16 million. Then there must be some gap that needs to be filled, and that gap is equal to 2.5, and we identified it as something called goodwill. So what happens following many acquisitions is that in order to balance the balance sheet, we introduce goodwill equal to, in this case, 2.5 million, which is pretty much the number we calculated before. And thanks to this, we now have equal changes or equal growth on both sides of the balance sheet, and we can safely say that our balance sheet meets the primary condition that the two sides of it balance. So the logic of goodwill following an acquisition is such that you need it for the balance sheet to balance.